You've been watching the stock market. There have been a lot of red down arrows with stock prices going down for a change. Terry Savage is going to sort it all out for us. How are you, Terry?
Hey, Terry.
Good morning. And in a way, it's a little bit better start to the day. The Dow has bounced back about 150 points this morning. You don't have to be even terribly interested in the stock market to hear these headlines about, is AI a bubble? Is it going to take away all our jobs? Is it going to extinguish the human race? And in terms of investing, are these billions of dollars being spent on the data centers and so forth? Is that just a bubble like we always remember the dot-com bubble? So without answering that, yes, AI is going to change our lives. I don't think it's going to wipe us out. And the jury is out, but today the largest company, the most watched one, so if you want to talk about it at dinner, NVIDIA will be out with its earnings, and the market's kind of holding its breath. I want to reiterate this. It doesn't really matter. The tech stocks, those AI stocks, are about a third of the Standard & Poor's 500 stock index, a much smaller percentage of the Dow Jones Industrial Average. If you're putting that money in regularly out of every paycheck, you don't care if it's a bubble because you got many years, and if prices go down, your $400 buys more shares. If you're closer to retirement and you're thinking, wow, look at my 401k, you might want to, as you get into your 60s, not because you're giving up on the whole stock market, but moving to something like the short-term bond fund with a part of your money, because we are at levels that are relatively unprecedented in the market today.
All right, let's get to viewer questions. As my kids graduate from college and start their first jobs, they are interested in making the most of their savings. They are taking full advantage of their employer 401k programs, but are wondering how to make the most of the money they are putting into savings. Is a high-yield savings account a good idea?
Well, this implies a lot of things. First of all, congratulations. Your kids are graduating and getting a job. It's been reported that this next coming spring might be one of the most difficult years for college grads. There's a lot of entry-level positions. They're not only wiped out by AI, but concerns about the economy. Second thing is, yes, of course, maximize the 401k. And if they have a choice between the Roth 401k, where they don't get a tax deduction, tell them if their company offers that to take the Roth option. How on earth could they have any other money left over, I'm wondering, unless you're lucky enough to have them living at home with you and they don't have to pay any rent, in which case a good old money market account in the bank, so they build up some cash for maybe the deposit on the apartment when they move out.
All right. This person says, I received a $90,000 inheritance. I won't need it to pay off some things for 6 months to a year. What would be the best place for me to invest it to get the best returns on that money for the next 6 months to a year?
Okay, well, let's have a reality check. When people come to me with questions like that, they post on my Ask Terry blog. I often respond with, wait, how much are you willing to lose? And then they go, no, I don't want to lose a penny. I just want to keep it safe. Well, safe would be 6-month Treasury bills, IOUs from the government. They're yielding about 3.8%. And if you were thinking, well, in 6 months I could earn 7 or 8 or 10%, that means you would be taking risk. So go to terrysavage.com, and one of the boxes there says how to buy Treasury bills. Safest place to put your money, and that's the market rate today, about 3.8%, unless your bank money market account offers something like that, 3.8%.
All right. I just turned 73 this year, and I understand I have to take money out of my IRA. How much must I take, and when do I have to do it?
Okay, this is the dreaded RMD, the required minimum distribution. The government, after giving you all these years of tax-deferred growth in your IRA or in your old 401k, because you have to do that separately, says you have to take a percentage out. It's a formula based on your age and the value of your account, not now, but at year-end last year, December 2024. There's a great article up at terrysavage.com on how to calculate your RMD. You want to take it now. Don't wait for the year-end rush. Have the money taken out, and hint, make sure they withhold at least 20% in income taxes. That's all taxable income. If you want to get tricky, the first RMD after the year you turn 73, you could wait till April 1st next year, but you'll also have to take another one next year, and that could boost you into a higher tax bracket or impact your Part B premiums for Medicare. So take it before year end, and before your custodian for your IRA is all jammed up in December, do it now.
All right, last question. I have young children. Should I freeze their credit to protect their identity from identity theft?
That is such an interesting question. I forget what movie or novel years ago someone appropriated some child's identity from a gravestone and their burial date and realized they could take their credit. That doesn't really happen, but every child is given a social security number at birth. So you can go to the three major credit bureaus. I hate to promote this. There's nothing for sale on my website, but a lot of free info. There's a box called Identity Theft Do This. Links to the three major credit bureaus. You can put a freeze on your minor child's social security number at least until age 16, meaning no one could use that number to open a bank account or take out a loan. I think that's really far-fetched and extreme, but it is something you can do.
All right, you have to ask Terry a question. You can go to terrysavage.com. Thanks, Terry.
Thanks, Terry.
Thank you.
Time for Around Town.
Hey, Anna.